All right, let's talk about two words you hear thrown around all the time: trading and investing. You've probably used them, maybe even interchangeably. But what if I told you they're not just different, they're like a 100-meter dash versus a full-on marathon? Yeah, that different. Stick with me, because by the end of this, you're going to know exactly which race you're cut out for.
So let's just dive right in. Trading, investing, aren't they pretty much the same thing? You buy something, you hope the price goes up, and then you sell it. Sounds simple enough, right?
Well, you'd think so, but not even close. The difference is actually huge, and it really just boils down to two things: time and tools. That's it. So let's break down both paths, and we're going to start in the fast lane.
Okay, so first up, we've got the trader. If you're thinking long-term commitment, forget about it. This is all about speed. It's like a series of really short, intense sprints. The whole goal is just get in, make some money, and get out. Fast. Really, at its core, trading is just a super high-speed game of buy low, sell high. And when I say high speed, I mean it. We're talking about holding onto a stock for maybe a few days, sometimes just a few hours, or even in some cases, just minutes. It's all about catching those really quick, tiny little movements in the price. So how do they know when to make their move? Well, their main weapon of choice is something called technical analysis. They're not really worried about companies' big financial report or anything like that. Nope, traders are glued to their screens, staring at price charts, looking for little patterns and signals. They believe the past price action can tell them what's going to happen next. You know what, to really get this, let's just walk through what a trader's dream scenario looks like, okay? Picture this. They've been watching the charts, they see a pattern they like, and they're ready to pounce. Okay, let's follow the play-by-play. They spot their chance and buy a share at $10. Boom, the stock jumps to 13. But their charts are telling them it's about to dip, so they sell right away, locking in a nice quick profit. And just like they thought, the price falls. They see another opening at $11, so they jump back in and ride that next wave all the way up to 16 before cashing out again. 4 moves, all in a really short amount of time. So in this perfect little world, they made $3 on the first trade and $5 on the second. That's a total of $8 in profit from just one share, all just by timing those little ups and downs perfectly. Sounds pretty great, right? But come on, if it was really that easy, wouldn't we all be doing it? The reality check here is that it's way more complicated and honestly, a whole lot riskier. And here's the big catch. All that chart reading stuff, it's about predicting. It's not a crystal ball. It's not a guarantee. So for every one of those dream scenarios, there's a total nightmare waiting. You buy at $10 and the stock just crashes. You sell at 13 and then it shoots up to 20. Just one bad call can wipe out all your wins for the day and then some. And look, this high-stakes game isn't just happening with stocks. You've got day traders who are in and out before the market even closes. You've got swing traders holding for a few days or weeks, and they're playing in all kinds of sandboxes: currencies, gold, oil, and of course, the Wild West of crypto. Okay, so that's the sprint. Now let's totally switch gears. Let's talk about the other path, the investor. If trading was the sprint, this is the marathon. We're not talking about quick wins here. This is all about the long game, crossing that finish line years, maybe even decades down the road, having built some serious wealth. See, investing is really about becoming a part owner in a business that you genuinely believe in. You buy in and then you just hold on, not for a few days, but for years. The whole idea is to let your money grow right alongside the company. And the tools an investor uses, totally different from a trader. They use what's called fundamental analysis. Honestly, they could not care less about the little daily wiggles on a price chart. Instead, they're like detectives, digging deep into a company's financial health, looking at profits, revenue, growth, and they're asking one simple but powerful question: is this a good business that's going to be worth more down the road? Okay, let's make this real. Imagine you find a company you love. Let's call it Wee Wee Shoes. You've done your homework, you've looked at their books, and you're convinced they're going places. So you buy 10 shares for $500. And now comes the hardest part of investing. You wait. You just hold on for the next few years, completely ignoring the crazy daily news and price swings. And it works. The company does great, and they even start paying you a little bit of their profit every year, which we call dividends. So fast forward 5 years. The company is huge now, and that stock price, it's tripled. You decide it's time to sell.
Your little $500 investment is now worth $1,500. That's a $1,000 profit. Oh, and don't forget that $100 you got from dividends. So all in all, you've earned $1,100. And what was the magic ingredient? Patience. And that right there brings us to the biggest hurdle with investing. It was summed up perfectly by maybe the greatest investor ever, Warren Buffett. The idea is simple, but actually doing it, it's not easy. It takes real discipline. It takes the patience to just sit back and let time do all the heavy lifting for you. All right, so we've looked at the sprint and we've looked at the marathon. Now for the main event, let's put them right next to each other, side by side, so you can really see how different they are. Okay, this is where it all comes together. First, time horizon. Traders, they're thinking in days, weeks, maybe months. Investors, they're thinking in years, even decades. Next up, analysis. Traders are all about the technical charts and patterns. Investors, they're all about the fundamental health of the company. Their focus is different too. Traders are just watching the price. Investors are watching the business itself. And maybe the biggest one, risk. Trading is high octane, high stress, and super risky. Investing, on the other hand, is generally much more relaxed and lower risk.
So after all that, you're probably asking yourself, okay, so which one am I? And honestly, there's no single right answer. It really comes down to your own goals, your personality, and just what your life looks like.
Look at it this way. If you're chasing quick profits, you're okay with a lot of risk, and you've got the time to be glued to a screen, then yeah, trading might be for you. It's basically a full-time job. But if you're looking for slower, more stable growth over the long haul, you don't like losing sleep over your money, and you need something that just kind of works in the background of your busy life, then investing is probably a much better fit. But here's the most important thing I can tell you. No matter which path sounds more like you, there is one golden rule. You have to learn before you start. Seriously, because if you jump in without a real strategy, you're not trading and you're not investing. You're just gambling. And we all know who wins in that game.
So I'll just leave you with this one question to chew on. When you think about your money, your future, what kind of race do you want to run? Are you a sprinter or are you a marathon runner? Only you can answer that.